welcome to the week 5 demo on partnerships, and I'm going to work through um, requirements just like your the example or the problem that you have to do. Um, there's not a chapter in the book explaining this. There are some links to articles that'll help you understand partnerships a little bit. So if you want a copy of the spreadsheet, just email me and I'll send you a copy. Alright, so we have two partners, A and B, and they're going to combine assets and liabilities of their separate sole proprietorships and combine everything to make a partnership. And so it's important to remember that we want to bring in all assets at market value, determined through appraisals, agreements by partners, things like that, aging of receivables, all those things. So partner A is bringing in a total or a net total of $13,000. We're going to take the assets, cash, accounts receivable, and machinery all at market value, and then subtract off the mortgage payable, and that then will give us the capital amount of A. B is bringing in net assets of $80,000, cash, equipment, and accounts payable. So you can see the journal entry that we would use to combine those two partners' books. And notice the cash is one journal entry here, so the cash comes in at 10 plus 20 is 30. Accounts receivable, just from partner A, the amount expected to be collected would be $5,000, so we ignore the 7. Then we have a mortgage payable, equipment coming in at 70, and then notice we don't need to worry about the accumulated depreciation because we're bringing in the equipment at market value, and then we'll depreciate it from that value. I added up the debit and credit columns just to make sure that they are equal and that I made this journal entry correctly. Don't forget to put in the capital balances, which would be their net assets minus liabilities for each partner. Then we're going to admit a new partner to the partnership halfway through the first year, and so they are going to buy, partner C is going to buy half interest and going to contribute cash to the partnership for that 1/2 interest. Okay, so that is important to know. This isn't a personal transaction or anything like that. Partner C is donating cash to the business, not donating, but buying a share of the partnership. So we're going to debit cash and credit the capital account for C, and that would be 1/2 of the 93,000, which is the capital of A and the capital of B. So that's how we get 46.5. All right. Then it looks like after the first year we're going to split net income of $100,000. Notice here I have $100,000 in net income. This is the bottom of the income statement, so the last line on the income statement is net income, and then we're going to just show how we're going to divvy that net income up. Partner A is going to get a salary of $40,000, which leaves us then with $60,000 left to distribute, and we're going to distribute that $60,000 evenly, $20,000 to each partner. So after we distribute the net income, partner A is going to get $60,000 of that 100. Partners B and C are going to get $20,000 each. And then that's just a worksheet. Of course, in part 4 we'd have to journalize it, and income summary is a holding account for the revenues and expenses. Once we close them for a partnership, we close revenues to income summary, we close expenses to income summary. Then in effect we have net income sitting in there, and if it's net income, income summary is going to have a credit balance, and so we are going to debit income summary and credit each of the capital accounts, increasing them by their share of the net income. In the last part of the problem, we are going to dissolve the partnership, and I have a trial balance here. Shows the cash and equipment, notes payable, and then the capital accounts at the point of liquidation. And so I just plug those balances here down into the worksheet. The first thing that I'm going to do is sell off the equipment, and in this case I'm going to sell the equipment for $30,000. The equipment has a value on our books of $60,000, so I'm actually selling it for a $30,000 loss. And so I'm going to break that loss up between each of the partners and reduce their capital accounts by 1/3 of the loss for each partner. And then I'm going to go and balance our accounts. I have 100. I got cash when I sold the equipment, so I have 170,000 in cash. I've sold the equipment, that's gone. Notes payable is the same, and then I have to reduce each of the capital accounts by the amount of the loss that I distributed to them. Then I'm going to pay off the liabilities, so I'll reduce cash, reduce the note payable, the other balances all stay the same. Now my cash balance should equal, if I look at this line here, my cash balance should equal the balance in my 3 equity accounts. Then I'm just going to go to the bank, pull all the cash out of the bank, and give each of the partners their share. And that's what I do here on this last line, distributing the cash. Now I also have to close the books with journal entries. So first I'm going to sell the equipment. I'm going to get 30,000 in cash, get rid of the equipment for 60, and so I have a $30,000 loss. Then I'm going to distribute that loss to each of the capital accounts, pay off the liabilities there, and then distribute the cash to each of the partners, closing down their uh, capital accounts and closing out the cash account. So those are the journal entries with a partnership. It's basically sole proprietorship, just with several capital accounts. If you have any questions, again, send me an email, give me a call. Otherwise, hopefully this week will go pretty well for you.